Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thank you very much for listening to my video today, and as usual, please don't forget to spike that and subscribe to my channel. I will really appreciate it. Thank you all to my new copiers as well as those existing copiers that have been copying me for a long time. I really appreciate and value all of your investments in me, and I do take them extremely seriously. So to start today's video, I'm going to be talking about what happened in the stock market and in the crypto markets last week. I'm also going to be talking about some of my key positions, as well as also touching upon key aspects of the strategy as well. So let's get started. So last week, it might seem a little doom and gloom because we were down about 1.44, but however, we must put that in context. We've been really up for the last several months, quite consistently, almost every single week. So it's quite normal for there to be a pullback. And one of the positive things that came for last week was I was down 1.44%. But if we compare that to the Nasdaq, which was down about 2.8%, and the S&P 500, which was down about 2.3%, then I think I did quite well. I think my overall aim really is to try to outperform the indices to the upside and try to outperform the indices to the downside as well. I think that we're doing pretty well on a year-to-date basis. Our portfolio is up about 24.05% for the year, so I'm extremely happy with that performance so far, as well as the Nasdaq, which is up about 32.9%. But it must be taken into account that the Nasdaq, the main reason why it's up so heavily is because there's a slight handful of stocks that are very highly weighted in the Nasdaq that have done particularly well this year. If we also look at the S&P 500, it's up about 16.6%, so we are outperforming that. And then if we look at other markets which we have stocks in, we have the FTSE 100, which is the UK index, which is up about only 1.26%. And then the Hang Seng, which is the Hong Kong index, which we have quite a few stocks in, is down about 2.69%. Bitcoin obviously has done extremely well this year and is up about 75.85% on a year-to-date basis. Just to round off what happened results-wise last week, the S&P and Nasdaq, yes, it did have a slight dip, but as I said, it's been doing very well for this whole way through this year. Europe also experienced some weakness as well. However, China did perform quite well last week comparatively to the other indices, so that did help our portfolio. BTC was slightly down. However, it has just been ranging recently. And I did do quite a few short-term positions. So a lot of you will know what happened in 𝗃. There was a hack. So 𝗃, for you that don't know, is a cryptocurrency. And there was a hack on 𝗃 on one of the smart contracts. And what happened is that forced the founder of 𝗃 had a very large loan on a lot of the DeFi protocols. And what happened is when the price went down because of the hack, this caused the price to go down to kind of 52-week lows. And there was a lot of fear that this owner could get liquidated. However, he did manage to stave off that liquidation by selling some of his 𝗃 tokens, some of his other tokens that he had in his treasury as well, and bought some OTC, which helped to widen his liquidation point, in which he was obviously very worried that would hit. And it seems to be the crisis has averted. Anyway, on that story, I did a short-term trade when it was near its lows for the year, and I did sell out at about 10.29%, and that is because I felt that it was quite ripe really for a rebound play, but I didn't want to hold it too long because there was a bit of risk there. However, it was weighted accordingly. I also did some other short-term trades in 𝗪𝗏, Orange Juice, Wheat, Domino's, and Vanquis Banking. So it was a pretty good week for short-term trading last week, which helped me to outperform the indices. So if we look at the main news for last week, as I mentioned, Nasdaq and the S&P 500 had a pretty weak week. Then Amazon and Apple both reported their earnings after the close of the market on Thursday. Amazon did particularly well, and it's one of our highest weighted stocks in our portfolio, and it significantly beat expectations, which was very good for our portfolio. And we saw a nice rise in Amazon, which obviously was good for other stocks on Thursday as well. However, Apple did slightly disappoint on their earnings and they marginally traded down. However, we don't have Apple in our portfolio. One of the main reasons why the markets were down in the US last week was that Fitch, which is the rating agency, has downgraded the credit rating of the US government debt. Previously, before, it was at A, and now it's been changed to A+. This has got some people in the markets spooked and did have an effect on bond prices and bond yields last week, and it also caused a little bit of a downturn in stocks. I personally don't think this is a major deal. There has been other times in history where the US credit rating has been downgraded, but obviously it's extremely unlikely that the US would ever default on its debt, etc. So I don't think it's a big deal in the long term. It's probably going just to have a few short-term speed bump kind of waves in the market. We also saw the unemployment rate in the US has come down to 3.5% from 3.6% the prior month. So this is basically showing, and it has the whole way through this year, the unemployment rate has stayed pretty low and at quite close to historic lows. And a lot of those people that were out of work during COVID, etc., have gone back to work, etc. I think the economy is looking pretty strong. The employment market's looking pretty strong. Retail sales are looking pretty strong. And we're probably coming to very close to the end of the interest rate hikes in the US as well. So I think it all looks pretty positive moving forward. And I think that's a big reason why the markets have done so well this year, because they're starting to reprice that in. If we move over to Europe now, and especially in England and the Bank of England has continued to raise its interest rates just like Europe and just the US, and it's now increased its interest rate again last week by another quarter of a percentage point to a 15-year high of 5.25%. And what they're saying is the central bank has predicted the inflation rate could fall to 4.9% by the end of this year. Obviously, that's pretty far away from the 2% target that the Bank of England has, like many other central banks around the world. However, it is starting to show signs that with these higher interest rates, that inflation will start to come down and it'll start to go towards more normal levels. If we look at house prices in the UK as well, obviously it's pretty obvious as interest rates in the UK go up, then what happens is it makes it very difficult for people to be able to afford to move and to take up new mortgages, whether you're a new buyer or whether you're an existing buyer. And people just generally don't, especially if they're on a kind of fixed interest rate mortgage. Why would they want to change over to a new mortgage and pay a much higher interest rate? So we are starting to see a real kind of downturn in prices of houses, etc. And that's why house prices fell 3.8% year over year in July, and that's worse than the 3.5% drop in June. So what we are seeing is an accelerating the prices of houses falling, and that is in July, that is the fastest decline that has been seen since July 2009, and we all know what happened then. Okay, annual inflation in the Eurozone has slowed further to 5.3 in July from 5.5. So again, similar story to the rest of the world. We're starting to see a reduction in inflation. However, they are pretty significantly behind the US just because they started to raise interest rates a lot later, and there was a lot of more dependency on oil because of Russia, Ukraine, etc. However, there are inroads and it is starting to come down. That is also another positive sign. In terms of the old Eurozone economy, has expanded 0.3% in the second quarter, and that is after the GDP shrank the previous 2 quarters. Again, the Eurozone economy looks pretty buoyant. It's growing, albeit quite slowly, and there's some real positive signs again in the Eurozone, where there obviously wasn't 6 months ago. If we look at China now, China did particularly well last week, and I think that is because the main news from last week was that the China's State Council announced new measures to revive consumption, which they're focusing on removing restrictions in sectors including autos, real estate, and services. As we know, the demand has been a lot less after COVID-19 that had been expected. It does take a little bit of time for demand to start to ramp up, and there was a special sectors in the China within the last kind of 18 months to 2 years which have done pretty poorly, such as real estate. We all know that they experienced a housing boom and then a housing bust over the kind of last 18 months or so. So they're trying to revive that by putting in friendly policies in order to encourage people to take loans, etc., at decent rates in order to try to promote consumption. We also see new home sales by China's top 100 developers slump 33.1% in July, and that is from a year earlier, extending declines for a second month. The People's Bank of China has again pledged to support the real estate sector in China by reducing housing loan interest rates and down payments, and is guiding commercial lenders to adjust rates on existing mortgages that they had. So again, another friendly policy in which they're really trying to promote consumption as well as promote people to continue to build, etc., in the real estate industry, and also to be able to move houses freely, etc. So as we move on to our top 3 performing stocks for last week, the top performing stock for last week is Wix, and that was up a nice 6.22% last week. Amazon, as I said, they produced a very good earnings report last week, which was seen very well in the markets, despite the rest of the tech sector really suffering last week. It was up a nice 5.57%. And the third best performing stock in our portfolio is Flowserve, which is an oil and gas related stock, and that was up 5.24%. So as we move on to our Death by Charts edition, I just wanted to bring up the chart to the left to start off with. And the first chart is the credit card interest rate at US average. So basically what this is really showing is that people are continuing to borrow on their cards, and the average interest rate on credit card debt continues to rise, hitting a record high of 20.7%. And this is going to hits pretty hard because a lot of people borrowed money and have continued to borrow money even when interest rates continue to increase. And we just need to keep an eye on this because people might at some point start having trouble paying back some of those credit card debt, especially at those very high interest rates. So there could be potentially some defaults. So worth keeping an eye on that. The chart to the right I wanted to show is the US real GDP year on year. And that shows the first report on US economic growth during the second quarter was a good one, with real GDP rising 2.6 year over year, and that is well above expectations. GDP is rising, albeit quite slowly. However, it's quite positive, I think, overall for the markets. The third chart I just want to show you to the left, and that is the Dow Jones Industrial Average. And really what I wanted to show you is the longest up streaks that it's had. And what we have seen this year is we've seen a big run in the Dow Jones in July, where it closed higher for 13 consecutive trading days. So that is in line with 1987 and the second largest win streak in history. So really in July we saw just continuous growth in the Dow and also in the S&P and the Nasdaq. So really we're showing that the economy and especially the stock market is that people are very optimistic about what's happening overall in the economy. I think a lot of it is because they're anticipating that these interest rates might have hit their peak and they might start to come down sometime within the next 6 to 18 months. So that I think a lot of that is starting to be priced in. Also, we've got to remember that it comes on the back of extremely difficult 2022. And quite often you see these nice rebounds the year after a massive slump. If we look at the chart to the right, this is the S&P 500, and there's the best performance through the first 143 trading days. And what we can see is the S&P is now up over 19% year to date. Actually, it's a little bit higher than that now from when I pulled this chart. And one of the best, and it's one of the best starts to the year that we have seen in recent history with the stock market. So again, very positive. If we look at a chart which shows the S&P 500 and the effective Fed funds rate, what we can see actually is that the S&P right now is actually 5% higher than it was when the Fed first announced its very first rate hikes from 0.25 to 0.5. We're actually 5% higher than that. So that just shows me that the market is really starting to believe that interest rates are going to go down sometime in the kind of near to medium term future, and the positive that we could have a no landing recession and that things could continue to be positive in the stock market. So there's a lot of optimism in the markets at the moment. If we also see the US PCE price index and the year-on-year change, what we can see is that the PCE price index has moved down to 3%, and this is its lowest level since March 2021. It's getting pretty close to that kind of 2% Fed target that they've had in mind, and it's very much close or in line with the average over the last 20 years. So I really think that they've actually done a pretty good job in fighting inflation this year. And what we have seen is just continued every time there's a new reading, the inflation data shows that it's continuing to coming down. I guess a key point will be at some stage, might they overcompensate and keep the rates higher for a little bit longer? And there's obviously a lot of lagging indicators in the market. And will they be quick enough, if there is a slight slump in the market, will they be quick enough to decrease those rates in a fast fashion and potentially stop deflation, which it doesn't often happen in the markets, but it can do. Last chart I just wanted to show you really just shows you how goods and services have gone down, and a big reason why the inflation data is showing a decelerating inflation figure. As we've seen gasoline, that's gone down 26.5% this year. Again, a lot of that is to do with the kind of last year oil prices were extremely high because of the Russia and Ukraine situation. However, it's improved over the last kind of year or so, and production's increased, etc. We are seeing a reduction in gasoline prices. Airfares as well have gone down significantly, 18.9%. Probably for two reasons. One, obviously, gasoline prices have gone down. That affects airline fares. And the other thing is obviously there was a huge demand after people not being able to travel after COVID. So we saw a big uptake of people wanting to take flights, etc., which put some pressure on the price. So that's down. We also seen car and truck rentals. They're down 12.4%. Again, that was another big story that renter cars, etc., were extremely expensive last year. And then we've seen some reductions in some appliances, such as televisions and a few other areas. And that, again, is probably mainly because of the supply chain pressures that were in place last week, and the shipping costs were extremely high, had to be passed on to the consumers, etc. So obviously that's gone down slightly. Lastly, eggs. So food was up a lot last year. So eggs in particular was down 7.9% for the year. So we are continuing to see a reduction in some of the kind of core goods and services. Okay, so as we move on to crypto now, I wanted to give you my news and views on the situation that's going on in crypto. So Bitcoin has been very flat over the last kind of couple of weeks, really. We did see about a month ago now, a month to 6 weeks ago, we saw a fairly good rise after there was a lot of anticipation about these Bitcoin spot ETFs that could be approved in the next kind of 6 to 12 months. There's a lot of them, from BlackRock to Fidelity and many other spot ETF applications, which we are expecting has quite a high chance of going through. However, that kind of has faded a little bit at the moment, and we're seeing Bitcoin ranging in that, I don't know, 28 to 30, 31 range. So I think it's pretty much doing what I expected it to do. We're coming pretty close to the halving. It's 10, 11 months away. So as we draw closer to the halving, there should be some anticipation of the halving happening, which will obviously reduce supply. And as we get closer to those Bitcoin spot ETF applications, decisions being made, I do expect to see an increase in price. However, as I said, I don't expect us to hit an all-time high probably until 2024. However, that doesn't mean that there isn't further upside in the next kind of 6 to 8 months. I definitely think there is. I just don't think we will hit all-time highs until next year. Then if I look at some other news that happened in the market, so PayPal has launched its own stable coin, which is very interesting because PayPal were at the very beginning of Bitcoin very against it. There was a lot of stories that PayPal obviously didn't like Bitcoin, and they made various jokes at conferences and exhibitions, etc. However, we've seen that kind of tide turn in 2021, where they started selling cryptocurrencies on PayPal and accepting it, etc. And what they have done now is they've made another further inroad by creating a stable coin. And I think there's going to be further demand for stable coins, because really at the moment, there are a lot of different stable coins on the market, such as US dollar tether, USDC, but I think there probably is still room in the market for a stable coin, which has a lot of power against it, with obviously the PayPal name, etc. So again, I think it's a positive development that some of the large organizations are looking to get into blockchain, whether that's just stable coins. There's been a lot of rumors recently about 𝗁𝗶𝗴𝗲𝗀 and that their offices were raided. And Justin Sun, who owns 𝗁𝗶𝗴𝗲𝗀, or was a major shareholder in 𝗁𝗶𝗴𝗲, has said that this didn't happen, and that 𝗁𝗁𝗴𝗲 is in a situation where they have a lot of funds. They're not worried about bankruptcy, and there's obviously been some fears that they might be slowly going insolvent, etc. However, he's tried to relieve those fears by coming out and say that they weren't raided. Who's to know what the actual truth is? It just shows you, really, as usual, not your keys, not your crypto. So if you can, always try to take your crypto off exchanges in the event that there is any further crypto exchange problems in the future. Another launch which happened a few weeks ago was WorldCoin, and this is a Sam Altman project. And what has happened is they've obviously created a token, and what they're really doing is they're trying to get as many people registered as well by retina scanning, etc. And they're going to try to roll out these large use cases for it. To me, it's not really my cup of tea, to be honest. I really like crypto because of its decentralization in nature, and I just feel like there's not a huge amount of privacy by people scanning their eyeballs, and it wouldn't be a project that I would invest in. However, again, it just brings a bit more eyes to crypto overall. And lastly, I just wanted to bring up the picture to the very far right is Adam Back, and he is one of the pioneers in cryptocurrency, really. And before Bitcoin was invented, he was part of the forum in which they talked about cryptography, and he was actually one of the first authors of a cryptocurrency called Hashcash, which was before Bitcoin. And he was one of the pioneers. And even in the white paper, Satoshi actually quoted him and cited him as a reference in the creation of Bitcoin. It's led a lot of people to think, could he have actually been Satoshi? Because he's one of the few people in the world still alive that actually had the kind of skill set to be able to pull off something like Bitcoin. Anyway, we will never know, and I'm glad we will never know, because it's much better that it's decentralized. However, what I wanted to say in this is that he has just made a bet with a random Twitter user that he thinks, and he's betting one Bitcoin, that Bitcoin will hit its all-time highs by the end of 2023. So that's a kind of a very bold statement. It goes a little bit against what I said a little bit earlier, where I don't expect Bitcoin to hit its all-time highs until at least 2024, after the halving. And that is mainly for historic reasons, because Bitcoin has always hit its all-time highs after the halving, as well as a lot of those Bitcoin spot ETF applications not facing the final decision. There's kind of first potential decision, second potential decision, but the final decisions, a lot of them aren't until either just before the halving or just after the halving. So I'm not expecting those to be approved over the next couple of months, so I personally don't believe we would hit all-time highs, but it doesn't mean that I'm not extremely bullish on Bitcoin and cryptocurrency, and that I definitely think that there's a high probability that Bitcoin will hit all-time highs next year because of what's happening. Lastly, I just wanted to show you this Bitcoin spiral halving cycle. So I'm not going to go into this in a massive amount of detail because, to be honest with you, it's a little bit complicated. But what we've really seen is that we have seen similar moves in Bitcoin directly after the halving. So we see each circular motion here is indicative to what's happened in previous cycles. So there was obviously been 4 previous cycles, and what we've seen is after the halvings, we've seen that we've started to hit all-time highs at a very similar time after the halvings in each cycle. Also, on the other end of that, we've also seen in the same stage of the cycle, we have also seen the bottoms in the Bitcoin price have all been very similar amount of time and amount of blocks in the halving cycle as well, where they have reached at a very similar time. So obviously history doesn't repeat, but it does rhyme, and especially with an asset like Bitcoin, which has been very uniquely created. And it's no coincidence that after the halving, Bitcoin tends to spike, because what happens is this new Bitcoin that is able to be mined and the block rewards are able to be mined by Bitcoin miners is reduced in half. That leads to less selling pressure. Then what happens is the price starts to spike, and then there's more demand for Bitcoin because the price is going up. And then we tend to see, eventually we tend to see these blow off highs where there's a lot of euphoria in the market. And honestly, it's repeated every single cycle. But what we do tend to see is as Bitcoin matures as an asset, what happens as well is you see the diminishing returns theory. And that is just because the asset is becoming slightly more mature. So that means that the upside is slightly reduced from the previous cycle and the previous cycle before that. However, the downside is also reduced as well, albeit still pretty volatile. So all in all, I'm pretty positive, especially leading into next year, and I hope you all are too. And well done for all of you who withstood a pretty difficult Bitcoin bear market and crypto bear market last year. I think you will be extremely rewarded for that patience that you have shown and that conviction that you have had. And I want to thank everybody for listening to this video today. If you haven't joined my Discord group, please join it. A really great community of people regularly having discussions on the market. So check the link in this video. You can see a link to that Discord group. And have a great week ahead, everybody.